Hello, everyone, and happy Friday. This is Etienne Bergeron from IA Financial Group for the video for the week ending August 21st, 2026. So the title of this week's video, the US Treasury under pressure. So we're going to talk about the rise in long-term interest rate as well as the intervention that Scott Bessent and the Treasury Department did over the week. We're also going to touch on this deal that should be announced today between Canada and the US. But as always, let's start with a look at the markets this week. So it was a pretty tough week overall for stock indices, although today seems to be in the green, at least as of now. Um, Stocks in the red across most regions. In terms of oil, we've had another increase this week of about 5%. So obviously the situation in the Middle East remains unresolved. The US dollar depreciated against most other currency throughout the week. That's partly because of this intervention that I mentioned just before. The Canadian dollar appreciated against the USD, so it has also to do with this agreement that is currently negotiated. So that is adding a tailwind for the Canadian dollar. Finally, gold has had another good week. So gold prices have been, you know, pretty good. Had pretty good outcome recently. We know there was a big correction in the spring and early in the summers, but things are looking better lately. Again, this intervention by the Treasury Department does have a lot to do with gold prices increasing. We'll discuss that a bit later. But for now, let's discuss this trade agreement between the US and Canada. As of Friday AM, when I'm recording this video, we don't have the full agreement yet. There's still details that needs to be resolved and still the possibility that the deal unravels before the deadline that is supposed to be tonight, so Friday at midnight. There's been little leaks so far about what this agreement means, but there's still a few things. So, in terms of details of the agreement, it seems that the U.S. has agreed to lower sectoral tariffs. So, for steel and aluminum, lower from 50% to 25%. There's still more details around, derivative products of either steel or aluminum. So it's a bit more complicated than just, the headline 50% or the headline 25%. So we'll see, we'll have more on that as details filter through. In terms of automobiles, the tariffs would be lower from 25% to 15%. Again, there remains some details to be confirmed regarding the exemptions. Currently there are exemption on these tariffs for the part of the vehicles that are made in the U.S. So will we have more exemption along those lines? That remains to be seen, but that can have a large impact on the actual tariff rate of cars that move from Canada to the U.S. In return, alcohol products would be put back on the shelves. There would also be adjustment made to Canada's supply management system in terms of dairy quota. Again, details are still TBD. Also, probably some stuff on energy policy, on security. We'll know more when this agreement is out. Key risk, I think, remains around provincial premiers. They don't appear to be overly excited about this deal. Doug Ford and Christine Fréchette in Quebec, I think still have some question, and it's not completely sure yet that they are willing to put back alcohol on the shelves. So that remains a key risk, and we'll see how it goes. And again, I think important to mention that there's no agreement that is officially signed yet. The deadline is tonight, so we might have a bad surprise. But I think overall, the cautious optimism is warranted here. And if indeed Canada and the U.S. sign a deal and we have an easing in these trade tension, even if we're left with some tariffs, I think it's broadly speaking good news for Canada, good news for the U.S. also. Now, does this deal mean anything for the Bank of Canada? So we've had inflation data in Canada over the week. Um, Overall, when we look at various measures of core inflation that the Bank of Canada is following, they all show, that on a year-over-year basis, inflation is well anchored around 2% in Canada. So that is good news. Overall, however, if we look at higher frequency data, for instance, 3-month annualized growth in inflation or month-over-month inflation, the picture is a bit I wouldn't say concerning, but it's a little bit it shows a little bit of acceleration in terms of inflation. So the graph on the right here shows that core inflation, excluding a few volatile categories and indirect tax, when we look at year over year, it's about 2.2%. But if we look at 3-month annualized rate, we're at 2.8%. And again, this sort of result can be seen across various measures. So uh, inflation has been accelerating in Canada lately, and with this trade deal, that if indeed we have a trade deal, it would remove one of the key downside risks that the Bank of Canada has been flagging for a while now, meaning trade tensions, higher risk of higher tariffs. So we remove that downside risk, and at the same time, we know that. Economic activity has been accelerating in Canada lately. So all of this means that interest rate hikes, will need to be considered over the next couple of meetings. Um, More than they were over the past several meetings. So I don't think there's anything that's going to happen in September, but the possibility that the Bank of Canada might hike rates in either October or December is increasing. In our scenario, we think that the bank will, increase interest rate back to a more neutral level. So that's two hikes from 2.25 to 2.75. Currently, we think that these rate hikes will happen in early 2027. But with the new information that we've had, it is possible that this could happen, late in 2026. We will see, and we will have time to update our views. As I mentioned, September, it's not going to happen, but I think the meeting is definitely going to be more interesting than the recent ones. All right, so let's move on to the main subject of this week. So, rising long-term interest rates. So, over the past couple of weeks, interest rates, at the long end of the curve, so 10-year interest rate, 30-year interest rate, have been increasing in the US, but also across the world. So there's three reasons for this increase. The first one is oil prices and inflation risks stemming from the situation in the Middle East. So that leads investors to require increased protection against these inflation risks, so higher interest rates for that reason. But that's not the main thing. I think the two main thing are first, fiscal policy. So we know in the US, fiscal policy is unsustainable, but again, everywhere across the world, governments are taking in more debt, issuing more debts to finance defense spending, to finance infrastructure spending, and also just finance relatively large deficits across many countries. The third reason why long-term interest rates are on an upward trajectory is the issuance, bond issuance by the tech sector specifically. So the corporate sector is also issuing a lot of debts. That's partly, mainly, I would say, to finance the AI build out, so building data centers and all that kind of stuff. And so this is a lot of paper. This is a lot of debt for the market to absorb. And this is a classic supply and demand. When the supply of debt increase in the markets, price go down, and that means that interest rates go up. So that's the situation that we have on our hand here. And so the increase in 30-year bond yield, for instance, in the U.S. went from about 4.9 in late June to 5.3% earlier this week, and that triggered this intervention by the Treasury Department. So basically, what they did is that they bought back a lot of long-term bonds. How did they finance this buyback? Probably by issuing more shorter term bonds. So it doesn't really solve any problem. It's just a way to move the problem from long-term interest rate towards shorter-term interest rates. But still, it had some positive impact, but probably it's going to be relatively short-lived. And in fact, I think it raises credibility issues about why the Treasury is doing that. And that may be why we saw a fall in the dollar over the week. That's also maybe why we saw a rise in gold prices throughout the week. So people are questioning more and more the sustainability of U.S. debt. And as a result, the dollar is paying the price here. And yes, this intervention, as I just mentioned, it's not really going to solve the problem. And in fact, the biggest problem for the US right now is the fact that their fiscal policy is completely unsustainable, and really it doesn't address the situation at all. So we've had a key number this week that came out. It's that the debt of the U.S. reached $40 trillion. So that's such a big number that I think it's quite impossible to wrap our head around it. So I think we need to look at maybe other metrics to have a better contextualize this unsustainable fiscal situation. So first, the budget deficit in the US, it's about 5.5%. In the latest data, it has remained very high since the end of the COVID pandemic. So despite a growing economy, the US continues to have a very deep budget deficit. One key metric to follow, and that's the graph on the right here, it's the interest cost as a percentage of government revenue. And right now we're about 28%. So for every dollar of revenue that the US government gets, they have to spend 28 cents just servicing the debt. And that's really big. And with interest rates that are continue to rise, with the debt that is continue to rise, this proportion will just keep rising and rising. And currently, they spend more servicing interest than they do on defense spending. And this is probably just going to get worse and worse. So this is a real puzzle that need to be solved. And neither the Republicans or the Democrat have shown any ability to solve it. There's political constraint, operational constraint, and it's unclear how this situation will end. So the intervention that we've had this week is just to put a little band-aid on the situation for a very short period of time, but we're still left with this fiscal mess that will need to be addressed at some point. To his credit, Secretary Bessent did mention fiscal consolidation. That's something they want to move towards. But I still don't have my hopes up here. I think it's easy to mention it, but having real measures in place that could have an impact, we'll see what they do about that. But yeah, a fiscal puzzle that remains unsolved, I think, is a good way to look at it. despite the intervention that we've had over the week. All right, so this wraps up the main subject this week. What we'll be watching next week. So in Canada, we will have GDP for the second quarter. So we expect a pretty strong growth in GDP. Looking forward to see what we have here. In the US, again, it's going to be a week with a little data of importance. We will have a consumer confidence from both the Conference Board and the University of Michigan to give us a check on the US consumer. We'll also have the PCE price index to give us more information on the inflation outlook in the US. So that's it for me. Sebastien McMahon will be back with this video next week. So I wish you all a good Friday and a good weekend. And thank you and bye-bye.